Risk reward is MarketAlpha's fastest way to answer two questions that matter in every setup. Is the upside worth the risk, and where should the stop go? And based on that risk, what's the minimum target that makes the trade worth taking? Every alpha chart includes an AI strategy overlay that makes this visual with a risk-reward candle so you don't have to guess. The red zone is your risk area with the stop price. The green zone is your reward area with the target price, with RR0 as any first resistance area, and RR as the final target zone. Let's take a look at another example. SLV is a top setup today that shows an AI bias of long, with a strong price confirmation, a risk-reward of 2.7, and a great path to target of 1. On the chart, we can see why. SLV is gapping up over the 50 days moving average pre-market after a confirmed bullish divergence. The stop sits below price at a meaningful area where multiple support zones intersect, and the final target sits above price where the next major resistance cluster begins. And that 1 in path tells you there's only one meaningful resistance, at the 20 days exponential moving average between price and the final target. So the way to target is relatively clean. Now let's take a closer look at what risk-reward actually means. Risk-reward compares your potential upside to your potential downside. This is the formula for risk-reward if we are looking at a long setup. Let's go back to our real example with SLV. Here's what we have. An entry price of 72.89 with a stop price below entry and a target price above entry. Using the risk-reward formula, we get a risk-reward of 2.7. In real terms, this means you get 2.7 units of reward for 1 unit of risk. This means if you're risking $1,000, you can get $2,700 of reward. Now let's switch to a manual short setup regardless of AI bias. Here we can see that SLV first must break down the 50 days moving average as the first support area to continue down further. For a short setup, the formula is slightly different as our target is below last price. Here we have the same entry price of 72.89, but a stop price above entry and a target price below entry. Using the risk-reward formula for short, we get a risk-reward of 2.1. So risking $1,000 here implies about $2,100 of potential reward. Next, let's talk about how MarketAlpha chooses the stop and the target. MarketAlpha always starts with the stop built from 2 layers. First, it uses structural logic to place the stop beyond the nearest meaningful area where support or resistance, and with it, supply, is concentrated, often a cluster where multiple levels overlap. That's what makes it a true invalidation level. Price has to break a real structural zone to prove the setup is wrong. These zones are built from all indicators on your chart, such as trend lines, moving averages and gaps, and key references from prior dates like the previous close, high, and low. Second, it uses systematic volatility control to keep the stop distance using ATR, or average true range. This way, the stop doesn't end up unrealistically tight or excessively wide. Once the stop defines the risk distance, MarketAlpha projects a target where the setup rewards at least 2 units of risk potential. Think of it as stacking risk units. If 1 unit of risk is the stop distance, then 2 units is the minimal distance needed for a risk reward of 2. At or beyond that zone, the system looks for the next closest meaningful resistance cluster and uses that as the final target zone, RR. Before price reaches RR, it also marks the first resistance checkpoint where price is likely to react at RR0, which has its own smaller risk reward. The same logic applies to short strategies, just inverted. And as price moves, MarketAlpha updates the stop and target for long and short strategies in real time, along with the AI strategy bias. For some of the best setups, the first target can be the final target. This happens when path is 0, meaning there is no detected resistance between price and the target. For example, let's take a look at XAR. It has a long bias with a risk reward of 2.2 and a path of 0. In this case, any first resistance is the target itself, so RR0 equals RR. These setups tend to have a cleaner route to the target with less overhead friction, so price can often get there more directly. In general, a higher risk-reward means you're getting more potential upside for each unit of risk. That's why MarketAlpha treats risk-reward as a core scannable field that you can filter. Using individual filters, find the folder AI strategies, where you can filter risk-reward across AI, long and short modes. Or you can use community filter groups for ready-made risk-reward filters, including first risk-reward to scan for RR0 as the first resistance checkpoint. This way, you can quickly find setups with the best risk-reward, where the upside is worth the stop, without wasting time on messy charts.